get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast.
Hello, welcome back to the Financial Purpose Podcast. Thanks for joining. It's episode 62. And today I'm just going to answer some Reddit questions. So I had a little bit of time on Friday morning, and I was just kind of blowing through Reddit because I really never do that. The platform kind of, it's largely responsible for all the GameStop, craziness that happened a couple of years back and some of the crypto stuff. And, some of those subreddits, there's just really weird stuff on there. And so I just pulled a handful of financial questions, and I don't know that we'll get through all of them. There's a lot of them here that I pulled out, but some of the questions I thought were interesting. Some of the scenarios I think are interesting, and they're probably things that a lot of people deal with. And what happens is you post a question like some of the ones we're going to discuss today to a forum like Reddit, and you're going to get just a random reply or a series of random replies. Now, some of the replies are actually really good. There's some really sharp people on there. I was going through a thread where somebody was discussing a certain scenario with discounting cash flows, and I was just like, man, somebody really knows their accounting stuff. This is really sharp. And then some of the questions that were asked and some of the answers, I was like, oh boy. Okay, somebody with a brain needs to jump in here to this conversation. So anyway, we're just going to go through these Reddit questions. These may be helpful. To me, this is all financial planning stuff, which is why I pulled some of these. Now, I haven't spent really any time on these. I just read enough of them. Took about 30 seconds. Can I answer that quickly? Should I answer that quickly? Okay, and put it on a Word document, and that's it. So this is all going to be live. I'm going to read the question. Here's the format. Read the question. I will read any of the context that the person asking the question put in there, and then I'll just give kind of an off-the-cuff answer, and we'll see how it goes. So here we go. Dale answers Reddit financial questions. All right, first question has paying off my credit card too frequently been damaging to my credit score? I've had it for years, but really haven't spent much time on it. Part of my pay used to be in cash, so I would just pay for these things with cash. I've been paying off any spends on my credit card a few days after making them. I'm looking to improve my credit score. It's currently 800, but I don't think I have enough of one for it to really count. I don't spend more than 30% of my credit limit in a month. I've never carried over any balance or paid any interest. So should I be waiting till the end of the credit cycle to pay the loan in full or pay the credit card in full? Has paying it off too early been preventing me from building up a more solid credit score? Okay, I'm going to answer this really quickly. If you have a credit score of 800, you're doing pretty darn good. So the credit scores range from about 350 at the lowest to about 850 at the highest. The average credit score in this country is somewhere in the, I want to say it's like 680, 690, 720, kind of in that middle of the range. Anything above about a 720, 730 is considered good. Anything above like a 780 or an 800 is excellent. So if you have an 800 credit score, I think you're doing just fine. Everything else that you're doing here is working just fine. It's much ado about nothing. Don't worry about it. Whoever wrote this question, if you're listening, you're doing great. Don't worry about it. Okay. Next question. How to save money when I was never taught how to? So I'm going to apologize for the grammar here. I didn't write these. But anyway. All right. This may be stupid, but I need some guidance. I just graduated high school, and I start college this week. I'm commuting first semester so I can save some money. My work schedule is inconsistent, and I find that's making it a lot harder to save money. I just bought a new car, and for the sake of details, let's say I owe $500 per month, which isn't too bad considering it's my only expense. I am very lucky. Also, I use retail therapy as a coping mechanism, which doesn't help anything. Bottom line, how do I save money when I'm irresponsible and impulsive? This is actually very easy to answer, and it's actually very easy to do. So if you're not taught how to save, or if you feel like having money in your account is impulsive, the easiest thing to do is to get yourself a couple of different bank accounts that are sort of linked together. And all you do is you have your primary, which for most people is a checking account. Go open a couple more savings accounts and send money to each of those savings accounts. And I've talked about this several times throughout the other episodes in the podcast. A savings account is a future spending account. That's its purpose. You put money there, you're going to spend it at some point for a very specific thing at a very specific time and a very specific amount of money, whether that's vacation or the holidays or a new car or college or right, all of these different things you can save for. That's what you do. Literally take the money out of your checking account, lower the limit on your credit card, or don't use your credit card, and that's going to help you start to control spending. You have to constrict it in order to control it. And then once you start to control it and you're living within that bounds, you can give yourself a little bit more freedom. But it's very simple. Just take the amount of money that you have to spend every month, get your non-discretionary expenses written down so you can see what they are every month. Even I keep a spreadsheet and another program that tells me where my money's going into what categories, because I need to see it as well. Write it down, get it somewhere where you can see it, find out what those I have to expenses are, and then put enough money in there to not be too much for discretionary so that way you don't overspend. So very simply, set up automatic savings, have money going to other accounts, get more money out of your spending account, and that'll help you save, and it'll also help you control where you're spending money, especially if retail therapy is your thing. Especially this time of year. Retail therapy can be a big deal this time of year because things are going on sale. The holidays are coming up. You know, you want to look nice or you want to buy something for somebody. Retail therapy helps some people feel better about themselves. It makes me feel worse, honestly. So there's that. Just set up ways to get the money out of your control. That's going to be a great way to learn how to save. All right, next question. What drives sell-offs? When the stock market experiences a sell-off, as happened yesterday, I don't know when yesterday was, but let's just say at any point in the past, what drives that? So don't sell during a sell-off seems like common knowledge amongst the people in my circles, but if everyone followed that, a sell-off would be impossible, or if everyone followed that, a sell-off would be impossible by definition because nobody would be selling. Is there anyone for whom selling in the event of a sell-off is actually rational? I'm thinking maybe people with leveraged options contracts or something like that, or are there really just enough people in the stock market whose behavior is dictated by animal spirits and not reason that an irrational sell-off should occur? Who the heck is selling during these things? Again, apologies for the grammar. All right, so the general question, what happens during market sell-offs? Why do people sell? Who's selling? What's going on here? So there are a lot of reasons why a market sell-off is going to happen. I mean, we're talking about things like sentiment. We could have interest rate changes, changes in economic indicators. News headlines can drive a sell-off. Bad earnings report from an important company, like as of late, NVIDIA, whatever their earnings are going to significantly drive the direction of the market. It used to be Apple. I know a long time ago it was as Apple goes, the market goes, right? That was the saying. And so you could have bad earnings. You could have people just profit taking because we've had a long run up. This happened in 2018. We had so much market run up from early 2017 all the way through the year with very little volatility. We get to the beginning, first quarter or so of 2018, and people start taking profits off the table, and so you can have that happen. Forced liquidations, options covering, right? Look out every third Friday of the month for that's options expiration date. There can be some volatility in the market there. Liquidity issues. If people need money, they're going to sell whatever their stocks are or wherever they have money tied up to free up liquidity. Sometimes they could be doing that as a hedging strategy where they think that there's more volatility expected. They're going to go ahead and do profit taking. They're going to raise cash in the account. They're going to sit and wait for an opportunity, and then they're going to go buy something. Or maybe they do it because they want to buy something else, so they have to free up the cash to do it. So it could be liquidity, could be sector-specific issues, which could be something like there was a bad drug trial, for an example, or maybe it's not even that. Maybe it's something like COVID, where we had multiple pharmaceutical companies who were benefiting from the vaccinations, or I still struggle to call them a vaccination because you got the shot, you still got COVID, so that's not really a vaccine. Whatever it was, the shot. And now that it's not important for people to get that and to keep the boosters up and whatever, now that nobody really is paying attention, I think I'm going to say this and people are going to boycott my show or something. But anyway, now it's not that big of a deal. So even if you look at a company like Pfizer, they're having one of their worst profit years. The stock price is abysmal over the past year, and it's just because they don't have anything really going now that there's no big COVID, and that happened for several companies. And so it could be something like that. It could be semiconductors. You could have an issue where right now, if supply is coming from Taiwan or from China, or if there's a lithium mine that is inaccessible, or if there's any sort of geopolitical issues moving supply, the whole sector is going to go down. So that's always possible. Global events, election fears, which is where it is right now, growth scares, which is what happened a couple of weeks ago, or actually back in August. At the very beginning of August, we had a day where the market just bottomed out over about a 4 or 5 day period. And that was a growth scare. It was, we had some economic data that didn't look good. It looked like maybe we were going to plateau or possibly be headed toward some early signs of recession. That has proven to not be the case, but you can have that. There's still algorithmic program trading. There's limit orders that get triggered if the market goes up or down. And so all of these things can cause a market sell-off. What really is important is whether or not after the sell-off, if we get any follow-through buying. So if anybody steps in to buy the dip, or if we start to get some programs that are written to buy at certain market down levels, right? All of that really matters as to whether or not a market sell-off is just an event or if it's going to be some sustained long-term volatility like we had in 2022. So it's a hard question to answer because there's so many factors at play, but that's why we might see a market sell-off. All right, another credit score question. Am I better off focusing on my credit score or paying off my student loans? I'm currently struggling to raise my credit score. I pay all my bills on time, but my credit score seems to hover around 675. Again, that's a good credit score. I have money saved up, and if I wanted to, I could pay off the rest of my student loans right now. If not, it can take several more years, and with interest rates, it will be more than expected. I've heard that being free of student loans at a younger age can give you a massive edge. What direction should I go? Now, there were a lot of answers to this question, and I'm going to say this is one of those questions where we want to keep personal finance personal. And so to answer this question, to me, the credit score is not that important unless you're trying to prepare to buy something big, like a house, as an example. And so you need a credit score that's going to be sufficient to get you into the better preferred lending programs and better interest rates. Then credit score definitely becomes important. As far as whether or not to pay off the loans and whatever, I would ask, what else do you have going on in your life? How is your savings reserve looking? Is it where you need it to be? Is that healthy? Are there any other debts that need to be taken care of? Maybe the answer is to just nuke the student loans if you have enough money and you can afford to quickly rebuild your cash reserve. And once the student loans are gone, that's fine. That should help your credit score as well to have those off there. But again, if you're paying on time, it shouldn't be hurting your credit score either. So with 675, I would wonder what else might be going on in the situation. And again, I would check what else financially it might be more important, and that's how I'd make a decision. So my answer is I don't know. What I would do depends on everything else that's going on. It would be worth looking at, I think. All right, next question. I bought I-bonds on October 1st of 2022 when the rate was more than 9%, but now my I-bonds are showing up as a 3.94% current rate. I'm a newbie to I-bonds. Can somebody please help me understand why it's so low? Is it not a fixed interest rate? This is an excellent question. Okay, there was a period in 2021 and 2022 when I-bond rates were super high, and that is because inflation was going up, and in 2022, of course, inflation peaked at about 9.1%. I-bonds followed that. And so I-bonds are set, just kind of as a brief education, they're set twice a year, May 1st and November 1st. And there's two sides of the interest rates. One is a fixed rate component, which is historically low. I think I went through the I-bond chart after reading this question because I was curious, how high has the fixed rate I-bond been? And it's like 3.5%, maybe 4% is the highest the fixed rate's ever been. So you've got the fixed rate, which at the time that they bought these, October 1st of 2022, the fixed rate was at 0%. And then there's a variable rate. And the reason that's set every 9 months is because the Treasury will look at what's happening, and they use the Consumer Price Index to set the rate, and it's supposed to be inflation adjusted, or it should be keeping pace with inflation. And so every 6 months, that rate is subject to change. But if you bought an I-bond in October of 2022, or actually at almost any point in 2022, your fixed rate is 0. And so that fixed rate will never change for the life of that bond. Until maturity, you're at 0%, and your interest rate is going to fluctuate every 6 months, and it's only going to be that variable portion. So for you, with I-bonds, now you've had your I-bonds for 2 years. Next October, you might want to start thinking about whether or not it's going to make sense to continue to hold this I-bond. It really depends on why you bought the I-bond. But again, this is a personal finance. Let's keep it personal. You would want to look at your I-bond, see what else is going on, see how much you have invested in this particular I-bond, and if it makes sense to forego the couple of months of interest that you would pay as a penalty to sell the bond ahead of maturity, and you can do that. So anyway, take a look at the rules around I-bonds. Go to the treasurydirect.gov website. There's a great primer on I-bonds, how they work. It's easy to understand. You can see the whole history of the I-bond rates right there, and that might make sense. So definitely check that out. Okay, next question. What would be the impact of not taxing overtime wages? So this is a good question because this is one of those things that's being batted around for this coming election here in 2024. So I work as a nurse, and we constantly face staffing shortages. I feel there are certain occupations that are necessary for the basic needs of society, like nurses, police, firemen, trash collectors, that the government could entice more people into by not taxing income, or by reducing the amounts taxed for income earned from overtime. More experienced individuals would stick in hourly roles due to the ability to have higher wage earnings and raise the overall quality of the services provided. Do you think the government doing something like this is feasible, or would the loss in tax revenue outweigh the benefit of improved, fully staffed areas of these workforces? Okay, this is a very interesting question. If the government were to, if they were to put something in place where they were no longer going to tax overtime wages, they would have to do something else that would have, they never do anything that's not at least revenue neutral. The government's never going to give a tax cut blanket without something else adjusting, because the Treasury very simply can't afford to just give blanket tax cuts or any kind of tax break or any kind of, allowable deduction or whatever without it showing up in some other place where the Treasury can generate revenue. So no secret, we haven't had a balanced budget since the 1999-2000 fiscal year in government. That's the last time that we ran a surplus. We've ran a deficit ever since. Our national debt has been crazy since about 2004, 2005. And so the Treasury needs to bring in money. If they didn't tax overtime, what's going to happen is it's certainly a windfall for overtime employees. Now, the problem is employers will still have to pay their share of the employment tax, the 7.65%, on those overtime wages, even though you technically wouldn't as the employee, because the government's going to give you overtime at no tax. So I think that there's going to be some issues with employers that they may not allow overtime, and that may be part of the rule, where employers who consistently allow so much overtime, maybe they get a penalty from the IRS or something like that. There would have to be something that would happen. There is no free lunch ticket in this country, especially when it comes to taxes in the Treasury. So I think it would be actually more problematic for employers. I think it would be problematic for the the Treasury. I think it actually would be problematic for employees, because I don't think that you would get as much overtime as you want. And so it would be like a really great benefit that sounds really awesome from a politician, that in reality just doesn't work out as well as it sounds. So I think that's going to be the case. I think not taxing overtime is probably much to do about nothing. I don't know that it would happen. And if it does, there's going to be some issues, and it'll be interesting to see what they do there. Okay, next question. Why do so many finance bros wear soft shell vests? It's uncanny. Literally everyone I see wearing one is in finance. It's like a goddamn uniform. What's the reason? Oh, man, I love this question. Here's what's funny about that question. I get it, too. I don't know. I see a lot of finance guys, especially this time of year, walking around in these vests, and yeah, it looks like half douchery and half, I don't know what. The funny thing is I've thought about buying one of those vests and like putting the Life Moves logo on them, because they look kind of nice. You can kind of dress them up a little bit, but I don't know. There's a lot of vests in the finance world. I don't know why. Okay. Next question. I have a dumb question. I'm a teen just starting out, so if you can help me, well and good, but don't bash me out because it's dumb. That's fair. So the question is, when comparing companies within a market segment, what are some key financial metrics I should focus on to assess their relative strengths and weaknesses? The very first answer to this question I remember was somebody said, this looks like a homework question and you should Google it. And I thought that was funny, because that's kind of how I read it too. But just answer the question. Within a given market segment, if the companies are close, especially if they're competitors, this isn't very hard to do. Just go to any number of services. There's no shortage of places to do this, but go out on the internet, research the company, pull 4 or 5 of them together, pull their financials, and you're going to want to look at things like sales, their turnover ratios, their inventory time periods, their price to earnings ratio, you're going to want to look at their earnings projections going forward. You want to look at orders and inventory and accounts receivable, and just all of those financial things, and compare them side by side. And you can start to get a pretty good idea of which companies are being more efficient, not only with their money, but who's growing, how well they're taking care of their customers. If you see a lot of revenue coming in, but a lot of revenue going right out, then there's something that's broken inside of that company. They're probably not running a very efficient financial controls for the company, and that's going to eventually lead to some issues and some turnover in management for sure. It's going to show up in the stock price. If you see a lot of money coming in, but you don't see repeating orders, then it either means that that type of company or that sector is truly transactional, or it could mean that you have one company who just isn't providing on the operation side for their customers very well, and so people are not repeating orders, they're not returning, and so that company will eventually run out of people to sell to, and you'll start to see revenues dip. If you see a company that just doesn't have high revenues and it looks like they just kind of hold on to things, then you might have a situation where they're serving their customers well from an operations standpoint, but they really don't have a good sales and marketing focus on the front side to be able to pull in enough revenue. And so oftentimes that can happen. Any number of these things can lead to an unprofitable company. It very well could be that they don't have the right sales and marketing on the front side. It could be that they don't have the right operations in the middle, and it could be that they don't have the right financial controls as well. So definitely take a look at those things. You can line them up, like I said, compare them side by side, start to get an idea of not only, number one, kind of what looks like average or normal for the industry, or you might look and say, well, what's out of whack with this company? And then you can dig a little further. Okay, next question. Dependent care FSA. Okay, I have a 3-year-old but never signed up for a dependent care FSA. Are there special rules or income limits that can apply, or anyone sign up if offered by their employer? Okay, this is a good question. I actually answered this one right on Reddit while I was reading it because nobody had answered that question. So there are a handful of rules around FSAs. Anybody can qualify. Typically, if you're married, both spouses have to be working for you to be able to use the FSA, which is a flexible savings account. What's important to know, though, there are no income limits. Dependent care FSAs can be used for, the child's health care, daycare, some other school-related expenses, that kind of thing. You can look that up and just make sure you're following what would be a qualified expense of the FSA. And again, it's a great benefit because you can put money in there pre-tax and you can use it tax-free. It's a nice little benefit. But the biggest thing with dependent care FSAs is they work like traditional FSAs. They do have a use it or lose it feature, and your employer can set the amount of contribution limits going in. Right now they're at, I believe it's 5,000 if memory serves correct. The IRS has held that number going through to 2024, going into 2025. They haven't indexed it, so the number's the same. But your employer can set a lower limit. They also can remove the feature that allows you to carry over the next year in a window. So what happens is if you have money left in your FSA, usually for the first 60 days of the new year, you can spend that money down or turn in receipts for reimbursements to get money out of the FSA. But if you don't spend it, it's gone. It goes back into the plan for the employer. It helps them cover administrative costs and maybe offset some other burdens, or they may be able to, as the employer, do a gift into other employees' accounts or things like profit sharing or whatever they want to do there. There's just some little nuancy kind of rules like that. Look it up, but definitely, if you have the FSA, the best thing to do is to look through the prior year. How much money did you spend for the care of the child? And then use that as your contribution amount into the FSA. If that was a normal year, if that was an abnormally high year or an abnormally low year, you definitely want to index and kind of set your limits up or down. But know what you need to put aside there. You don't want to overfund it. It's not going to benefit you. You're not going to be able to get the money out, and you'll end up just giving it away. So, if your employer offers one and you have children, check it out. There is an age limit for how old that child must be for you to be able to use the dependent care FSA. I want to say it's off the top of my head 14 or under, but again, double check those rules, spot check them, and check out the FSA for yourself. It's a great little tax benefit. I prefer HSAs. If you qualify, HSAs are great. They have higher contribution limits. They roll over. You can set how much money you want in cash in the HSA at all times. The rest of it can be invested, and you can use that HSA. You can contribute to it all the way up until you're retiring, and I believe until you're on Medicare, and then you can use your HSA money for retirement. You can take the money out and use it for healthcare expenses, whatever. So it's a really great feature that might be a better option if you qualify. All right, next question. I think, nope, I already answered that. I'm flipping my pages here. Okay, here we go. Just got married and have some extra cash. My wife has this book where you add cash to these little pockets that number 1 through 100. So she has $1, $2, $3, $4, $5, etc., all the way up to the $100 spot filled up. That's a neat little book. I've never seen one of those, but that's an interesting way to save like that. She recently had it filled up and just keeps it in a drawer in our bedroom. It totals $5,050. So I'm wondering what we can do with that. I recently got an email from Wells Fargo about a 4.25 CD, but we are really inexperienced with handling money. What are your recommendations for somebody with an extra $5,000 laying around? Great question. Again, this is one of those let's keep personal finance personal, because $5,000 for some people can really make or break certain things. It can be a way to, you can certainly put that aside into a CD if it's not money that you need. It would be better to put it to something like a CD earning 4.25 than sitting in a drawer in the house earning nothing, because every day that you hold on to a dollar bill, it loses value the longer that you keep it just in its dollar form. So it needs to be earning interest. It needs to be finding other dollars. I think the last episode I call it sign your money up to be in a money cult, right? Where it goes out and it recruits other dollars to come back home with it. So you definitely want to do that. But yeah, I mean, you could put it into a CD if you're not using it. If you need it to, if you need to pay off a debt, do it. If you're saving for an expense like a vacation, or look around the house and see what really needs to be done. Maybe is that money that you can use to better yourselves? Can somebody get a certification or a degree or something that's going to allow you to earn more income, right? There's all sorts of things you can do with that amount of money. There's a lot of possibilities. And $5,000 in the grand scheme of things isn't a lot of money, but for some people that can be life-changing, especially if you can take that $5,000 and invest it into something that's going to generate more return. So that's what I would recommend there. Again, it just depends on so many things that are happening in your life, but if you can use it to better yourselves, either collecting interest or getting invested into something else that's going to be beneficial for the family, great. I, of course, don't recommend blowing it unless if you haven't had a vacation for a couple of years. I'm going to tell you there's some mental health reward that comes with that. So maybe you need to just take $5,000 and go get away for a week or two, and just kind of clean up your brain, get yourself ready for the next run, whatever it is. So anyway, a lot of different things. Keep personal finance personal. That's my recommendation there. Okay. This question is really freaking long, but it's interesting. Okay. My income is unusually low. Should I realize some long-term capital gains and pay 0% in taxes? Ooh. I'm doing an extensive bicycle tour around Oceania. That sounds like fun. And my 2024 income will be unusually low, about $10,000 USD of earned income from my last month of work plus accrued overtime, alongside another 4,000 USD or so of dividends from a Vanguard brokerage account. Let's round up and say it's 15,000 total in income for the year 2024. I made the maximum Roth IRA contribution, so I'm good in that department, but my brokerage account has a lot of unrealized long-term capital gains, nearly 80,000 USD of long-term unrealized capital gains. That's not bad. And I'm wondering if I should realize some of those to take advantage of the 0% long-term gains rate since my income is so low. Does it make sense to realize some of these gains, perhaps 25,000 or so, in order to lock in the 0% tax rate, which at 15,025, that's going to put you at 40. That's going to be pretty close to the single filer tax bracket where you would go from 0 to 15% cap gains rate. Okay. So should I do that in order to lock that in with the understanding that I'd reinvest it after 30 days? I'm currently all in on the, it's the Vanguard. I believe it's the S&P 500 fund. VTSAX is the ticker. It's just a mutual fund. That's in my brokerage account with a target date retirement fund in my Roth IRA. I have no pressing need for the money, so that I don't need the money. So that's important to know. Time horizon is very long, also important. I want to increase my cost basis and put the money back into the Vanguard fund to avoid upsetting Vanguard in creating a wash sale. That's also very important to consider. But the wash sale won't matter unless you're taking losses. So that's a non-issue. The way I see it, I might miss out on 1 month's worth of growth in dividends, but who knows what the tax situation will be in 20 years. That's a good point. From that context, locking in a 0% rate sounds appealing. Am I overthinking this? Yes. Is it not worth the complexity? For what it's worth, I'm a pretty frugal person, and I have never had an annual income above $40,000. I have no huge expenses in the future, no plans to buy a house, a car, or to get another degree, but I'm open to taking advantage of my unusually low income for the year. End of question. I told you that was long. Sheesh. Okay. Maybe is the answer to that. So if you need the cash, it's a great time to lock in low capital gains rates, right? We do this kind of stuff all the time with clients. We're going to move money around. It's all going to be tax related. And some of those decisions are, do we front load income in this year to reduce the tax burden next year? Do we push income out of this year into the next year so we keep the tax burden lower this year, shift it that direction, do some additional planning, right? We do this all the time. So if you don't need the money, just let it run. Why you would want to increase the tax or the cost basis would be to reduce your tax burden later when you sell it again to fund the next level of retirement or buying a house or whatever that is. And I understand that, but at this point, if you don't need the money, I don't know. Maybe you take some off the table because, Jim Cramer style, ring the cash register. Maybe, yeah. But if you need to fill up the tax bracket, or if you want to fill up your tax bracket and take capital gains off the table, that's fine. You can do it. If you don't need the money, it's fine. But I would say there's a couple things in here where there's just some misunderstanding of how these things work, and that's not a big deal. So Vanguard, frankly, doesn't care about your small brokerage account. Even if there's $80,000 of gains there, they don't care about that. This mutual fund that he's in has a very low cost basis, so it's of no consequence to them, really. They're not going to miss $25,000 coming off their balance sheet for a client redemption. That's not a big deal. So yeah, I think you're overthinking it a little bit, and really just if you want the money, take it. You won't pay capital gains on it. That's a great situation to be in. I guess age would be important here because you'd want to take a look at this because there's going to be some income planning around Medicare premiums for parts B and D. Go back and listen to the Medicare episode I had a couple of episodes ago with Hector and Lauren Dessis. Maybe that's going to be Social Security taxation planning. There's all sorts of things we'd want to look at. So again, another key personal, finance personal, and that could be interesting. Okay, this is a fun question. My mom has been using my 21.99% interest rate credit card behind my back. Please help. I let my mom use one of my credit cards when our cat needed emergency surgery of about $1,000 back in June. She told me she'd pay me back by the end of the month and asked me to let her keep the card so she could make the payments directly. I wanted her to send me the money instead of letting her keep my card, but I wanted her to pay it off ASAP, so I let her keep the card. At first, she paid $200, so I stopped paying attention to the statements because I thought she would just take care of it. In parentheses, big mistake. I didn't say that. That's written. Eventually, I was on a trip abroad and got a text from the credit card company that I had only $10 limit remaining on the card. I started freaking out and checked my statements. It turned out my mom spent around $2,000 on the card without telling me. And I know this because the money was spent on Amazon. I double-checked, and they matched with what she had ordered, and in beauty salons, etc. Because I didn't know about this and haven't made any minimum payments. I've just been charged almost $100 each month just in interest alone. I've been basically begging her to make any kind of payment, and she hasn't for months. I have really bad anxiety around financials, probably because my mom is so terrible with money, and the stress of being in this much debt and having so much charged in interest is literally killing me. Okay, I'm not gonna keep reading this. Cancel the flipping card and be done with it. Like, cut that off. cut mom off. So if she is burning your credit card account and she's ruining your credit score and she's going to stiff you with this bill, I guarantee it. Cut it off. Turn off the card. Be done with it. Get a new card. Just call the credit card company and tell them you lost your card, and they'll send you a new one. And then any charges coming off that card are going to be shut down anyway. Just cut her off. This is really bad relationally as well. There's going to be a lot of issues. It's going to be really hard to have a happy holidays with this kind of stress between parents and kids. And this is the kind of stuff that like splits families. So yeah, end this card thing. Have a hard conversation with mom and tell her that the party's over. She's going to have to help you pay this thing off. The card's no longer going to work. Get yourself cleaned up there, and kick mom out of the never do this again, right? That goes in the never do this again file. That's a sad situation. Okay, next question. And I'm just going to go through a couple more of these. Next question. Which should I pay off first? Similar balance with different terms. I've got two pieces of debt. One is new and one is 2 years old and has a remaining balance. The balances are both rounded up and pretty much the same. So I have $40,000 at 6.99% interest for 180 months at around $290 per month payment. The second piece of debt is $40,000 at 5.88% interest for 72 months, which started in December of 2022 at around $850 per month payments. So would it make sense that I would pay off the higher interest rate as that would end up being more money in the long run, but the second loan has a higher monthly payment, which is more onerous on our bank account? Would it make sense to pay off the lower interest loan and keep the payments at $850 and pay extra to the $699? Okay, I would do. Okay, there's two ways you could do this. One is the debt snowball, which is what they're talking about, where you pay off the higher interest loan first, and then you snowball that payment into the next highest interest loan, and then you keep doing that until all the debt's paid off. Or there's a debt avalanche, which is where you start with the higher balance or the higher payment on a monthly basis, and then you attack that, so then you have more fire or more fuel to add to the fire paying the next one off. So in this case, the interest rates are so close. The cost of debt is very, very close. If there's 72-month loan, which is already 2 years at play, and so you have, 48 months left to go at around $850. Yeah, pay that off. I would attack that $850 with as much extra payment as you can, especially if it's onerous on the bank account, right? So they said that. So get the higher payment paid off first, and then take that $850 and just slug that second $40,000 as fast as possible, because you're going to be making your payment of $290 plus another $850. You're going to pay that off really fast. Should be out of debt in just a couple of years with those two. So that's what I would do. If you have extra money, maybe you flip that around, since it's only $290 per month, but it's a $180 term. $180 month term. So it's just going to take longer to pay it off. I would, I think I would probably just attack the one at $850 and see where we go from there. Okay, I'm going to skip that. This is a good one. Okay, removing financial advisory services. After my investments went beyond seven figures, I hired a financial advisor, and all of my accounts were rolled into Fidelity. I had a couple of 401ks that were just rolled into a large IRA. My wife has a Roth and a traditional IRA, plus we have a couple of joint brokerage accounts. I'm between jobs, and I'm leaning on the advisor a lot more than in the past, and I'm finding that the responsiveness to my needs is not where it needs to be at the moment. We aren't seeing the value for the 1% fee we're paying. I'm exploring potential fee-only advisors and other options, but for the immediate time being, how do I efficiently remove the advisor from my accounts? Can I remove them and keep the money in Fidelity without the management relationship? Is it actually just easier to move to a different investment firm altogether? I read through my servicing agreement, and it seems like All I need to provide is 30 days written notice to the current advisor, but I wasn't sure if I need to get Fidelity involved or what the process is from there. Thanks in advance for any help. Okay, this is a great question. So if you have multiple accounts and you're between jobs and you're paying a financial advisor a 1% of your assets under management and they are not responsive to you, what that tells me is there probably isn't enough money that they're managing for them to really care whether or not you stick around. I know that sounds terrible, but legitimately that's what it is. And so if you need help from the advisor and they're not giving it to you, it's possible that you have the wrong advisor, because sometimes you do have enough money. They should be doing some other planning work with you, but they're just not. And so you need to say, am I working with an advisor who's just simply always out to lunch? Or am I just not important enough for the advisor to really care? Either way, once you kind of figure that out, if they're not the person that's helping you do what you need to do, in this case, yes, you should be able to call Fidelity, tell them that you are going to fire the financial advisor and you would like to keep your accounts at Fidelity. They will absolutely have a process for that. I know Schwab does. That's where a fair bit of the money that I manage for clients is held. And yes, a client can absolutely remove my authorization, which is just, it's a simple account. It's an LOA. It's a letter of authorization. It's like a, I think at Schwab, it's actually a limited power of attorney is what they have on there. And so that can be revoked by you, the client. You can remove the power of attorney. The advisor would then no longer have access to your accounts, and then you would be paying the 1% fee. Now, Fidelity will probably recommend their in-house financial advisors. They may even have somebody that they recommend you to, and that's fine. If you need the help of an advisor, though, I would definitely, in this case, look at fee-only advisors in your area or get a recommendation. You don't have to work with somebody who's directly in your area. I have clients all over the country, and they all just come in from referrals, and they live where they live, and it's not a big deal. But work with a fee-only advisor. It might cost you a little more, or it might feel like it's going to cost a little more, because oftentimes you're either paying that fee directly from your, like an ACH bank account type relationship, or maybe even a credit card, or you're being charged that fee to your investment accounts, and then you're a little bit actually more aware of what you're paying when you work with a fee-only advisor, because they say my fee is X number of dollars per year. It's paid quarterly or monthly or however they do that, and so then you actually know what you're paying. When someone says, "Oh yeah, it's just 1%," you're like, "Oh, that's pennies," and then you look through your statement, and you're like, "Wow, maybe it's not pennies." So I think you'll have more transparency if you work with a fee-only advisor. But yes, you can remove the advisor if they're not serving your purposes, if they're not helping you do the things that you need to do. Go find yourself somebody who wants to help you. Okay, I'm going to pull one more question. Let's see. Which one? There's a couple of really good ones here. Which one do I want to pull? Spouse IRA. This is an easy question to answer. I recently married and my wife does not have a Roth IRA. I was wanting to open a Roth IRA account for her. She currently works but will not be working next year. Can I open a spousal IRA for her right now, even though she makes a salary? I'm planning to file taxes jointly, if that makes a difference. Okay. So with a Roth IRA, the first thing to remember is that there are income limits. And so in 2024, that income limit is $230,000. That's where it starts to phase out. So if you're earning less than that, you're eligible for a Roth IRA. If your spouse is working, they will open the IRA for themselves and make a contribution. There's no such thing as a spousal IRA, but there is a spousal IRA contribution. And so that's what I think they're thinking of here. So if your spouse is not working, the working spouse can make a contribution on their behalf into an IRA up to the IRA limits, which for this year is at $7,000, plus you would have the $1,000 catch-up contribution if that's you. So you can do that for your spouse. So if they're currently working, they open the IRA, they make the contribution. If they're not working, the only way you can do it is through a spousal contribution, and they would have to sign that they're allowing you to do that, or they're accepting you to do that on their behalf. So that's pretty easy to answer. Okay, I'm going to pull one more question here. This is great. Okay, questions about withdrawing from a 401k. My wife was let go from her company a few months ago, and while talking with our financial advisor, he suggested that if we get into a situation where we're running low on savings, before she begins putting money back in, hold on, let me read this again. We were talking with our financial advisor. He suggested if we get into a situation where we're running low on savings before she begins putting money back in, that since she isn't working, we could make a partial withdrawal from her 401k. However, after talking to the company that's holding those earnings, they said she could only withdraw a portion if she were to roll over the rest into an IRA. This is her personal 401k. I, nor anyone else other than her former company, has made deposits to it. Duh. It's her 401k. Nobody else can make deposits to it. Okay, so my questions are, number one, would we qualify for a hardship withdrawal? Probably not, but there are some very specific rules you need to look up. Number two, is the account considered inactive since she hasn't made a deposit for at least 3 months? It's not inactive, but she's no longer an active participant. So I guess maybe nuance, maybe that's just that's a word salad thing. But no, the account is still active. It's still invested. It's still doing what it's supposed to do. She just is no longer able to make contributions. Would we be subject to taxes by rolling that money into an IRA? No, a rollover is tax-free as long as you do it within the 60-day window. So no, take the money from a 401k if you want, roll it into an IRA, not a taxable event. Okay, and then it finishes up. We're trying to find the best way of accessing a portion of this money with paying the least amount of penalties and taxes. Any help is greatly appreciated. Thanks. Okay, here's the deal. If your spouse or you are 59 and a half or younger, you will pay a 10% early withdrawal penalty unless you qualify for one of the very few hardship criteria, and in just not working and needing money or having a tight budget, that's not a hardship. It's not going to work. So you're going to pay the 10% early withdrawal penalty, and then you're going to pay taxes at your ordinary income rate. And so the easiest way to do it is when you withdraw the money from the 401k to roll it over to the IRA. There is an option where you can roll over a portion. You can roll over all of it, or you can take a full lump sum distribution. And then as far as whether or not there's a penalty and how much you're going to be taxed depends on which option you choose. So if you take a portion of it, you're going to pay the 10% penalty. You're going to have tax withheld, and then you're going to receive the difference. If you roll it over to an IRA and then make your distribution, it's a little less complicated because all you're doing is taking money right out of the IRA, moving it to your bank account or getting a check from the fund custodian, and they're going to withhold taxes, and then you'll have the 10% penalty as well. So there's really no great way to get around that unless you're over 59 and a half, and then you just don't pay the 10% penalty, but you'll still have the tax on the money that you earn. I'm sorry, the money that you withdraw. You'll have the tax on that at your ordinary rate. So I would say with the financial advisor, if they're suggesting that if you get into a situation where you're running low on savings and you're pulling from the 401k, I would see if there's any other option, because typically you want that to be the last option available. Sometimes if you're still working, a 401k loan can make sense as a stopgap, but even then you really just want to be careful not to mess around with retirement money very much, because not only does it carry taxes and penalties, but it interrupts compounding, and it fundamentally changes all of your projections for how you're going to take care of yourself at a later time, later in life, in retirement, etc. Okay, so that was it. That was Dale Answers Reddit question. So if you're running through Reddit and you see a question, you're like, I wonder how this would go, shoot it to me in an email. I'd love to have that conversation. And you can send that to info@lifemoveswealth.com. I would tell you to follow me on Reddit or like my post. I don't even know what my Reddit username is because I just recently set it up, and they give you those goofy names anyway. It's random. I don't know. I don't know what it is, but maybe on another episode I'll say, hey, my Reddit name is blah 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 blah, and you can go back and thumbs down any of my responses or thumbs up them. Hopefully, whatever you want to do, or ask questions directly. I'll be happy to take those. So again, info@lifemoveswealth.com. Please be sure to like, subscribe, and share the podcast. This has been kind of fun to just kind of spitball on some Reddit questions. Maybe we'll do an episode like this again here in the future, because this was just kind of, like I said, a lot of fun to see what people are asking about and thinking about, and some weird financial stuff that people get into. So that's it. Until next time, take care of yourselves. Go be financially awesome. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.